Once all the transactions have been recorded, the accountant's responsibility is to prepare reports that users can use to analyze the company's financial information. The income statement summarizes the revenue and expenses for a specific period of time, such as a month or a year. Since the income statement is prepared for a period of time, the concept of matching expenses and revenues is critical. In order to determine if a company experiences a profit or a loss, the company computes the total expenses for a period and matches those expenses against the total revenues reported for the same period. The purpose of the income statement is to report to the user whether the company's operations are successful or not. This is measured on the income statement by the computation of the net income or net loss. Net income or net loss is computed by comparing revenues and expenses for a period of time. An excess of revenues over expenses results in net income. The excess of expenses over revenue results in a net loss. The statement of owner's equity summarizes the changes in the owner's equity that have occurred during a specific period of time, such as a month or a year. The income statement reports on the revenues earned by the business during November. Each expense incurred by Net Solutions during November is reported on a separate line of the income statement in a section labeled Expenses. For readability, the left column is used to list each of the expenses. The expense column is added, and its total, $4,450, is labeled Total Expenses. The total expenses are then listed in the right column. Notice that the first amounts listed in each column have a dollar sign, but the amounts that follow do not have a dollar sign. The total expenses, $4,450, is subtracted from the fees earned of $7,500, and the difference is labeled Net Income. When the revenues earned by a business are greater than the total expenses of the business reports a net income. If the total expenses are greater than the total revenues, the company reports a net loss. The first item reported in this statement is the beginning capital. Since this is Net Solutions' first month of operation, on November 1, the beginning capital balance is zero. The $25,000 investment is reported in the right column of the statement. Notice the use of the dollar signs for the first amounts reported in the column. The net income that was determined on the income statement is listed directly under the owner's investment. The two amounts in the left column are then added together. When two amounts are combined, it is customary to use a line under the last amount. You can think of the line as a shorthand for equals. $25,000 plus $3,050 equals $28,050. The subtotal, $28,050, is not described. The withdrawals of $2,000 is listed on the next free line after the subtotal of $28,050. The left column is then added, and the total of $26,050 is listed in the right column. It is labeled Increase in Owner's Equity. The increase in owner's equity of $26,050 is then added to the beginning capital balance of $0 to determine the new capital balance of $26,050. The final amount of this statement, $26,050, is given a dollar sign and is double underlined. The balance sheet lists the assets, liabilities, and owner's equity as of a specific date, usually at the close of the last day of a month or a year. The form of the balance sheet shown in Exhibit 6 in the text is called the account form. This is because it resembles the format of the accounting equation, with assets appearing on the right side of the balance sheet and liabilities and owner's equity appearing on the left side of the balance sheet. As of the end of November, Net Solutions has 3 assets. All 3 assets are reported in the Assets section of the balance sheet. The order that they are reported is important. Cash is listed first because it is the most liquid of assets. The nearer an asset is to being converted into cash, the higher up it will be listed in the Assets section of the balance sheet. Like all financial statement columns, the first amounts in a column are given a dollar sign. Accounts payable of $400 is the only liability. Liabilities are listed on the right side of the balance sheet. The $400 of accounts payable is given a dollar sign because it is the first amount in the right column. This form of the balance sheet is called the account form. It mirrors the accounting equation with the assets on the left and the liabilities and owner's equity on the right. Next, the ending capital balance from the statement of owner's equity is listed below the liabilities. The assets column on the left is added together and labeled Total Assets. The right column is added, and the total is labeled Total Liabilities and Owner's Equity. Both of these totals are double underlined, and dollar signs are added. The total assets, $26,450, equals the total of liabilities and owner's equity of $26,450. The balance sheet proves the equality of the accounting equation. A statement of cash flows is a summary of cash receipts and payment for a specific period of time. The statement of cash flows is made up of 3 sections. The ending cash balance shown on the statement of cash flows is also reported on the balance sheet as of the end of the period. The first section is called Cash Flows from Operating Activities. This represents a summary of cash receipts and payment from operations. Collections of cash from sales of goods or services, cash payments to purchase inventory, and cash payments for expenses incurred to generate revenue are all examples of operating activities. The second section is called Cash Flows from Investing Activities. This section reports cash payments for the acquisition of relatively permanent assets. It also reports the cash receipts from the sales of those assets. The third section is called Cash Flows from Financing Activities. This section summarizes cash received and dispersed through owner's equity transactions and through long-term borrowing activities.